Well, let's move on to the markets. The US Federal Reserve Chairman Ben Bernanke was out and about this week. He was on Prime TV this time, unusual for him. Here's the nub of the message.
There hasn't been a double dip or a second recession, and right now I think the odds of it are pretty low. But with forecasting, you just never say never. You have to keep vigilant.
Yeah, but the thing is, the market isn't really that vigilant. Look at this graph of the S&P 500. It's absolutely taken off over the past 4 months, I guess, 5 months. Huge increase. So the market's not being vigilant.
The market's only trading at its average PE in the US. We're at quite a big discount. We're about 11.5, whereas our average is about 14.5, 15. But they're only trading at average. It's not like there's a bubble over there. And the other thing is the safe haven assets everyone's got fed up of. US bonds are yielding 2%, have done for ages. Inflation over there is 2%. You get zero return, and potentially, if the markets take off, everyone's going to sell them. So you're in a real big risk, massive risk asset there. Everyone's bought gold, a highly speculative commodity, and thinking it's a store of value, which will only be a store of value if there's Armageddon, we get down to baked beans and shotguns. And that returns zero. And putting it under the mattress returns zero. You've got to buy something, and that's what's happening. People are switching out of bonds and into equities because, and the price is right in equities, especially here.
The Federal Reserve has said that interest rates are staying at zero until the end of 2014. I mean, that's the behaviour of a central
Alan, but
that's the behaviour of a central bank worried about depression, not just being vigilant.
But it also encourages and facilitates a one-way bet, doesn't it? A carry trades from you borrow cheaply in the States and you invest in anything that produces a decent return. Which is why every time the risk recedes in the global environment, the Australian dollar goes up. Because people look at our real rates and say, this is attractive. We borrow in the States at a few percent and we invest in Australia and get 6.
I think the other risk is we're always trying to find the bottom of the market. We're not talking about the bottom of the market, we're talking a rally in a bear market. And that's perfectly possible.
So what do you think?
That's perfectly possible, yeah. I think we could, and in the Japan's had 58% rallies in the last 20 years. It's gone down 80%. I'll have one of those.
Well, I think we need to get a bit of a straw poll on. Is it a bear market or a bull market or what? What do you think?
Who cares? Just go with it. It's a trader's market.
Spoken like a true stockbroker.
No, you can't say it's a bull market. You can't set and forget. You've got to trade. You've got to keep an eye on it now.
You've got to start dipping your toe. You've got to dive into it now, I think. As Marcus is saying, it's cheap. Why not?
Well, as you know, Alan, I'm bearish. I think we've got a decade where the world doesn't grow very much. And
I don't disagree.
And in that environment, you're not going to get bull markets.
No, we're going to get rallies.
But you're better to be in equities than bonds maybe now.
Well, not necessarily. You might be better off in cash.
Cash, I suppose term deposits, anything, you're saying anything below term deposit, forget about it.
Yeah, we're not going to talk about it anymore.
Yeah, that's right. So we're not talking about it anymore. That's where we'll have to leave it for now. Thanks to our guests, Marcus Padley, Nabila Ahmed and Stephen Bartholomew, and thanks for your company. We'll see you next week.